Welcome to NC Planning's informational video on business formation. At NC Planning, we believe it is important to understand our client's situation and help them choose the best plan that fits their personal or business needs. The objective of this video is to inform you about the different types of plans so that we may select the best one for you. Decide on the best entity for your business. We will discuss the differences between the S Corp, C Corp, and the most popular structure, the LLC. LLCs are popular because, similar to a corporation, owners have limited personal liability for the debts and actions of the LLC, but require less ongoing formalities and are more flexible as to the structure and taxation. In other words, the owners cannot typically be held personally responsible for the debts and liabilities of the LLC. To form an LLC, the appropriate formation documents, called the Articles of Organization or Certificate of Organization, must be filed with the appropriate state agency and the necessary state filing fees paid. The LLC is so popular because members have flexibility in structuring the management of the company. The LLC allows for pass-through taxation as its income is not taxed at the entity level. However, a tax return for the LLC must be completed. Any income or loss of the LLC, as shown on this return, is passed through to the owner or owners. The owners, also called members, must then report the income or loss on their personal tax returns and pay any necessary tax. The S Corporation's special tax status eliminates the possibility of double taxation common to C corporations. With S corporations, a corporate income tax return is filed, but no tax is paid at the entity level. Instead, the profits or losses of the corporation are passed through to the shareholders and are reported on their individual tax returns. With an S corp, the IRS imposes restrictions such as the number of shareholders cannot exceed 100. Shareholders must be individuals, estates, or certain qualified trusts, and they cannot be non-resident aliens. Also, an S Corp can only have one class of stock. The C Corporation is the most common corporate structure for larger entities. The C Corporation is a separate legal entity owned by the shareholders. Because of this, the shareholders cannot be held personally responsible for the debts of the corporation. To create a C corporation, the proper formation documents, typically called the Articles of Incorporation or Certificate of Incorporation, must be filed with the appropriate state agency and the necessary state filing fees paid. Taxation implications are usually a significant consideration when deciding which corporate structure to choose. The shareholders of C corporations may experience double taxation, which simply means that corporate profits are taxed at both the entity and individual levels. Profits of the business are reported and taxed at the entity level first. Then, if the corporation distributes any portion of the remaining profits to the shareholders in the form of dividends, the shareholders must report the dividend as personal income and pay taxes on it at the individual level. NC Planning will communicate with you to make sure you are selecting the proper business entity for your situation. Once we have confirmed your choice, we will begin to file the initial documents for your new business. Also, rest assured, if we feel you have made the wrong entity choice for your business, we will discuss this with you and make changes as needed. NC Planning wants to ensure that you and your business feel protected and positioned to take advantage of the opportunities desired. Let the NC Planning team assist you in achieving your entrepreneurial goals now and in the future.